So you're doing business in Japan, or thinking about it. Great. But there's a crucial detail about how your company's assets are taxed that can really impact your bottom line. We're talking about fixed assets and depreciation. The rules here are, well, they're different from just about anywhere else, and you really have to understand them. Let's break it down and make it simple.
So, if you're expanding into Japan, you're going to want to pay close attention. How you account for that new computer or a company car or really any piece of equipment. It can lead to some pretty significant and honestly often surprising tax situations that directly hit your cash flow. Let's dive right in.
All right, here's our game plan. First, we'll quickly cover the basics of assets and depreciation, just to make sure we're all on the same page. Then, we get to the real heart of the matter, Japan's unique two-tax system. After that, we'll compare the national and local rules, point out some special exceptions you really can't afford to miss, and then we'll wrap it all up with the key takeaways.
Okay, first things first. Before we can get into the really unique parts of Japan's tax system, we've got to lay down a quick foundation. Let's make sure we're aligned on what we mean by an asset and how depreciation works in this context.
So in Japan, a depreciable asset is generally any item your business uses that's going to last for more than a year and costs 100,000 yen or more. We're talking about the usual stuff here. Machinery, company cars, office furniture, and yeah, even the computers your team is using every single day.
And depreciation? Well, you can think of it as a bit of accounting magic. It just lets you spread out the cost of that asset over time for tax purposes instead of taking the whole hit at once. It's supposed to reflect that the asset is losing value as you use it. Simple enough, right? Well, this is where Japan adds a fascinating little twist.
Okay, now let's get to the single most important concept in this entire explainer. Seriously, if you remember one thing, make it this: Japan's two-tax system for assets. Understanding this is absolutely critical.
That's right, you heard me correctly. Unlike most countries where there's one set of rules for an asset's tax treatment, in Japan, every single one of your depreciable assets is being managed under two completely separate tax regimes. At the same time, this is where most of the confusion comes from.
So on one side, you have the national corporate tax. This is the big one most people think about. It affects your company's income tax. But on the other side, you've got this local fixed asset tax, which is basically a property tax that's charged by the local city or town where the asset is physically located. Two systems, two different sets of rules for the very same asset.
So what does this actually mean for your business day to day? Let's put these two systems side by side and see just how differently they can treat the exact same asset. This is where the details really matter.
This table really tells the story, doesn't it? Take a look at the depreciation method. For your national tax, you get to choose. You can use the simple straight line method, for example. But for local tax, nope. You're locked into one specific method, an older one that deducts more in the early years. And timing? For a new asset, the national tax is calculated from the exact month you buy it. The local tax just says, we'll assume you bought it mid-year. But here's the real kicker, the one that can impact your budget for years to come. For national tax, you can depreciate an asset all the way down to a single yen, basically write it off completely. But for local tax, depreciation slams on the brakes once the asset's value hits 5% of its original cost. And this leads to a really crucial point. Think about it. Just because you fully depreciated a machine down to 1 yen for your corporate income tax, that doesn't mean you've stopped paying tax on it. That same machine, sitting with its 5% residual value, is still on the local tax books, and you'll keep getting a tax bill for it, potentially for many, many years to come. It's a huge disconnect.
And it doesn't stop there. On top of these fundamental differences, there are special tax provisions that create even more of a gap between the two systems, especially when you're dealing with smaller assets.
Okay, this is a classic gotcha moment, so listen closely. For assets that cost between 100,000 and 200,000 yen, there's a special rule. It lets you depreciate them over just 3 years for your national tax. And the best part? They are totally exempt from the local tax. That's a clear win. But there's another very popular rule for small and medium-sized businesses. It allows you to immediately write off any asset that costs less than 300,000 yen in the first year. And here's the catch. That write-off only counts for your national tax. Those same assets are still completely taxable at the local level. You'll be seeing them on that local tax bill year after year.
Okay, we have covered a lot of ground here. Let's take a deep breath and pull it all together. I want to summarize the absolute must-know points from everything we've just talked about.
So, let's recap. First, and most importantly, burn this into your brain. Japan has a dual tax system for your assets, national and local. That's takeaway number 1.
Second, the rules for these two taxes, everything from the methods to the timing to how low the value can go, are totally different. Third, remember those special tax breaks? An asset you've already fully expensed for your national tax could still be racking up a local tax bill for years. And this even applies to assets that are just sitting idle in a warehouse. And finally, what's the bottom line for you? It means you absolutely need two separate ways to track your assets if you want to stay compliant and manage your budget effectively.
And all of this really leads to a crucial question for your business. Managing Japan's dual tax rules isn't just some boring accounting task. It's a core part of your financial strategy. It affects your cash flow, your compliance, and your long-term planning. Honestly, getting this right from the start is fundamental to your success here. Thanks for watching.